Everyone knows about QQQ, the tech-heavy growth ETF that dominates the Nasdaq for decades. But what if you could take that same exposure and add a monthly income stream? That's exactly what QQQI is designed to do. Today we're breaking down the real differences between these two ETFs, which one fits your portfolio, and how to use them together for growth and income. I had a viewer who asked me to do a side-by-side comparison on these two funds, because the big question is, should I go with growth or should I go with income focus? And we're going to look at the difference in the two and maybe try to decide which would best fit your portfolio. And we're going to look at some of the decisions you'll need to make that determination. So let's get started. Back to Simply Money. So let's start with a brief overview. QQQ, the classic Invesco Nasdaq-100 ETF, is a pure growth play, heavy tech weighting, where QQQI, a newer options income ETF, a covered call strategy built on the Nasdaq-100, paying monthly distributions. The question is, do you go with the tried and true growth monster or take the trade-off of slower growth for consistent income? Okay, let's look at the chart that I've created here to do a side-by-side comparison. Just to get started, we have the month of when QQQI started, so we're comparing from then, and so we're not going to get as far back as we could. But this will give us a good overview for the short amount of time that we have, just about a year and a half here. So we have the price of QQQ, we have the number of shares held. We went with a $50,000 initial investment with no ongoing contributions, just for this comparison. So with $50,000, we were able to get 119.91 shares of QQQ. When we go over here, we'll show here the dividends per share when those were distributed and how much the dividend would pay. This will be the amount in dollars. And then we have how many new shares, because we have the drip on in this scenario, how many new shares that the dividend was able to buy you. And that gives you your new share total right here. And that brings us to the balance after the dividend. So this is what we'll be looking at for QQQ. Then we'll be comparing that down here with QQQI. And again, this is going to be a mouthful saying these QQQ and QQQI over and over, but we'll see how many times I mess that up, and you can leave comments down below if you're counting that for me. So here, the QQQI price with the $50,000, we were able to get 1,017.5 shares. How much the dividend is, and how many and how much dividend payment in dollars that would be, which is basically the dividend amount times the number of shares that you're holding at that time. Slide over here a little bit. We go to the QQQI, how many new shares you can buy with that dividend payment. Again, because we were dripping in this scenario, and that gives us our QQQI balance. And then here in this row, I'm showing the difference. So if it's positive, that means QQQ is ahead. If it's negative, that means QQQI is ahead. So in this right here, QQQI is actually up $336 more than QQQ. And I'm going to highlight that because here in a little bit in the video, we're going to talk about that and kind of why that's happening and why that can be important for you and what that can mean for your portfolio. And when deciding, should I be strictly in QQQ or should I be strictly in QQQI, you're going to have to make that decision. Obviously, this is not financial advice. This is for entertainment, informational purposes only. But I'm going to share some scenarios to where one may be better than the other. Or maybe you want a little bit of a combination. Maybe you go 80% QQQ and 20% QQQI. I got to keep track of how many times I'm saying Q, and that's why the I is always delayed on that. You're laughing at me. You go ahead and try it. You do a little video and say QQQ and QQQI 20 times and see how many times you mess up. Anyway, we're just going to go through here in these different scenarios. Let's go down at the end, and we'll bounce back and forth a little bit. Here at the end, July 31st, 2025 is the last that we're going to use because we don't have the full month of August as of the making of this video. You can see with QQQ, the price has appreciated 35.5%, where QQQI has only appreciated 7.12%. And that's right there where people are going to be like, see, you should go with strictly growth. but there's more to the picture than the growth of the actual fund. And we're going to see some scenarios why you may want to lean one way or another. And I'm going to precursor this by saying, if you have a 30-year time horizon before you're going to need the money, I would almost always say, yes, go with QQQ. I mean, that's me. That's my opinion. If I had a 30-year horizon, I would probably focus strictly on the growth aspect and not worry about the income, because you do miss some of the upside. But you're going to see why that missing some of the upside can be valuable for other people who maybe don't have that time horizon, or who are already in their financial independence. They're retired, or they're retired early and they're in FIRE. So we're going to see the difference where, yeah, I'm willing to give up this 35.5 for this 7.12 because of the other aspects of that. But just going through here, you can see we didn't gain a lot of shares. Went from 119, we'll say 120, up to 121, because the share price and the dividend is minimal. It's just a little trickle of a dividend. I think it's like less than a % dividend yield, because it's a growth fund. It is focused on growth. So you're not going to be able to drip a lot in there. You're going strictly on growing this thing on the NAV and what it's valued at and market share. So you can see you gained 1.21 shares, and that brings your total value with the price as of the end of July to $68,530. So you gained $18,530. Now let's compare this to QQQI. You can see, as we already showed, that the share price has gone up 7.12%. It started at $49. It's gone up to $52.64. Not a huge gain there. The number of shares that you've held has gone up tremendously. You've gained 230, give or take, shares. And the dividends per share we have here, each share, look at this here. Your first dividend payment was $604, and this is a monthly payer. And you can see how, for the most part, it's gone up. There's a couple little dips here, and that's when the share price dropped. But you can see over time we've gone up, and now we're looking at almost an $800 dividend payment for July, because your share price is going up and you're gaining shares. So it is naturally building a dividend growth for you. And the number of shares that you're gaining, you can see that you're gaining, it's pretty much 12, 13, 14. Now it's starting to hit 14, 15 shares per month that we're gaining. So our total number of shares have gone up to 1,261 from where we started at 1,017. Our $50,000 investment has grown to $66,000. So with the drip on, having income, if you're dripping, doesn't have a huge impact immediately. You're not really feeling that. You're not using the money. So why would I want that? I'm giving up, in just this year and a half, I've given up $2,122 in growth because I have this drip. But look at this. I've gained so many more shares, and you're going to see in a minute where that can become important. Again, if I'm 30 years out, I may focus strictly on the growth. I may not care about the drip. Some people want it. I'm 56. I'm at the point where at any day I'm pulling the trigger and I'm going to stop the drip and I'm going to be using this. So I'm in a different place than some other people. You need to make that decision, and those are some factors that you're going to have to consider. Let's look at this difference here. This row here is something I want to look at, because this is one of the reasons why some people like the QQQI or other covered calls that are maybe not as strong in a bull market for the covered call ETF compared to the underlying. But right here you can see where your share price, as you can see, dropped $20 from the month prior. And same thing happened with QQQI. The price dropped from 51 down to 48.68. You're going to see the trend when there's a fairly significant drop. Not every time there's a drop, but if there's a fairly significant drop in share price, you will actually see QQQI doing a little bit better than QQQ. You can see here we're up with the covered call ETF, $336. We're going to look down here. We have it again. We have line 16 here. The QQQI price, where we went from 51 down to 47, and then it stayed right in that 47. You can see we're up when that happens. And you go over here with QQQ, same thing. It dropped from 508 down to 468, 475. So it dropped, but when it climbs back up here to this 523, and over here, when the price goes back up to 50, you can see QQQ starts pulling ahead again. And here's why that's important. If you are wanting something to help buffer, to help hedge against downturns, against bear markets, then those ETFs help do that. The problem is when they start recovering, especially in a super aggressive bull market, they are capped on their upside, so they start losing ground. So again, if you have a long horizon before you're going to need this, the time is the key. Maybe you want to go with more growth or all growth on this. And I'm not saying put all your money in QQQ, but your growth aspect. I want to get into tech. I want to be into something very aggressive like QQQ, but do I want income or growth in this portion of my portfolio? That's where you're going to have to decide. I'm on a different time horizon, so I like this buffer. But even better is we're going to slide over here now. And what I did was I turned off the drip, and we have to take withdrawals from QQQ. So let's start here with QQQI. We have no drip. So this is the amount of the dividend that I get paid. You're going to see that it stays pretty consistent. There's some dips. It still grew some as we go down here to the bottom. We're at 648 compared to 604. So not a lot of growth because you're not buying more shares. You can see the price of QQQ because I'm not adding more shares and having that. You can see the price doesn't grow as fast either. But likewise, and this is where you have to do the comparison. Some people don't do this comparison. They're going to compare, say QQQI, they're taking out the income. But if I'm retired, if I'm using this income, with QQQ, I have to pull out income, which means I have to sell off. What I did here was I took the same amount of dividend that QQQI provided. You have your balance, but you have to subtract $604 this month because I want that income, just like I do with QQQI. So I have to sell off. You can see that you start with 119 shares, but you end up with 98 shares. And this is only after a year and a half. This is a retired person or somebody on, using the portfolio for my income. This is going to be where I'd be like, I don't want to sell off, especially right here where the market's dropping and my share price is down, means I have to sell off more to get the same amount of dividends that the income portfolio is providing. It is something to consider. As I have the drip off in QQQI, I have gathered $11,180 of dividends. With QQQ, I've had to withdraw that $11,180. So it's pulled my share quantity down to 98, where my share quantity for QQQI is still at that 1,017 that I originally bought because I've never had to sell any, especially for in a prolonged bear market. I don't have to keep selling off. This is where income ETFs and income stocks can be really powerful. And for me personally, what my goal is when I decide that I'm going to stop working or focus on different things, whatever the case might be, that I'm withdrawing from my portfolio, I don't want to have to sell off. My goal is to use strictly dividend income. And I'm going to be having a new video coming out that I'll be updating my income portfolio on a month-to-month basis and showing what income is being generated. Right now, it's all dripping back in. But if I was to turn that off, you could see how much that I'm making on a month-to-month and what I can use to help live off or to at least supplement when I get old enough to get Social Security, other streams of income, or however I decide to do it. But my goal is I want to leave my portfolio alone for my wife if something happens to me, and if something happens when we're both gone, as a legacy for our kids to pass that on as an inheritance to them. That's what my goal is. And you can see here with the drip off, you're getting the income. The income's the same because we're selling off the same amount of QQQ. You can see where we're at. Balance of QQQ now is only $5,403 above where it was when you began, and QQQI is only $3,561. But this here is what really scares me, this 98 shares. Maybe this will start going up when the price gets higher and one share is worth $20,000. I don't know where it's going. But we have dwindled just in a year and a half, basically 22 shares out of our 120. If that trend continues, we're going to slowly have to continue to take more and more shares sell off to keep up with our dividend income that we want. Or here, I'm just keeping the same number of shares, and I'm getting $648 a month of income. And so it's that peace of mind that it provides. What are your thoughts on this? Did I miss something, or is there something that you're saying, whoa, dude, you totally missed it, you messed that up? Leave a comment down below. You don't have to, beat me up or anything, but leave a comment. I'm open. I know I make mistakes. These charts, there's a lot of information I have to put in here and import, and maybe I get a formula wrong. That happens. I had someone correct me on a video a while ago because I spelt cumulative wrong, and I laughed and I looked, and sure enough, every one of the times I wrote cumulative, I wrote it wrong. Spelling's not my strong point. Math is my strong point. I like numbers and I like charts. So if you see an error, feel free to correct me. I do not mind. I want to be corrected. I want to fix it. I want to provide as accurate of information as I can. Do you like these charts? I'm going to do another one for SPY and SPYI. Another one of my holdings is SPYI that I shared on a video. You can check that out here where I show my new holdings of QQQI, SPYI, and my experiment with ULTY. I also hold large shares of SCHD, which I've done many videos on that, and I'll continue to throw that into the monthly updates on a quarterly basis because SCHD, as many of you know, pays quarterly, where these pay month to month, and ULTY pays weekly. That's why it's an experiment for me. But I'm in on QQQI and SPYI. I plan on holding these for long term. I like what I see. I took my position from JEPQ, my JEPQ position, rolled it over into QQQI and SPYI so I could diversify a little bit more and to bump my yield up slightly. So that's the reason I've done this. This is the type of stuff I like doing, looking and comparing. Do you like this comparison? I'm glad for the person who asked me to do this. I appreciate it. I think this is great to visualize. I'm going to go back over here one more time. This is, to me, again, the big difference is when you decide to turn the drip off. Let's just go back over here to close up. Imagine if maybe 5 years before retirement, you rolled your QQQ over to QQQI, and for 5 years, you're accumulating by dripping more and more shares. So you're driving your monthly income up. And then when you go to start turning the drip off, you have a substantial dividend income from that. And you don't have to worry about selling off and what's going to happen there. That's it for today's video. I do appreciate you joining me. I appreciate all our new subscribers. If you like this video, please hit that like and subscribe button. It really helps us out, get more videos to people trying to reach financial independence. Share this video with your friends, family, if they're interested in learning things. Again, really helps us out. I do appreciate it. And we'll see you next time on Simply Money.